I start with thanking ACRAA and its office bearers to give us an opportunity to make this presentation today. And a good day to all the participants. Thank you for logging in. Just a brief of the sector that we are going to talk about today before we dive into the presentation, which will be made by my colleague. According to reputed research organizations like Oxford Economics, or even according to the World Economic Forum, worldwide investment in infrastructure is expected to be huge in the range of $80 trillion to 100 trillion by 2040. And half of that is estimated to be in Asia. Transportation, the sector that we're going to cover today, and electricity are expected to constitute a significant chunk of such investments. This huge outlay or this capital requirement definitely cannot be fulfilled only by states or sovereigns and would require private investments to play a significant role, not only in funding, but also in execution of projects. Needless to say, banks and financial institutions are expected to play a large role. Worldwide, it has been observed that the most prominent reasons for infrastructure failure are lack of long-term funds or liability matching and delay on part of state sovereigns to mobilize resources or give clearances, overestimation of revenue forecast, overtly complex projects, and talent strategies. So, as we all know, borrowings by the infrastructure sectors are largely non-recourse in nature, unlike debt raised by corporate or manufacturing entities, and therefore evaluation of sponsors who typically would have a limited economic incentive or strategically compelling reasons to support long concession debt-heavy projects becomes imperative and important. Alongside, it is extremely critical to evaluate these infrastructure projects on the basis of their own viability and creditworthiness, which can build confidence in infrastructure lending as well as development. This is where proper risk assessments through models, frameworks, monitoring helps lenders and investors to take prudent investment decisions, which are commercial lending decisions, pricing mechanisms to be used, and avoid any pitfalls. Back home in India, CARE Ratings enjoys a leadership position in assessment of infrastructure sector through its ratings. And in today's session, we will be presenting to you how to evaluate infrastructure projects from a credit risk perspective. While the broad principles of assessment are common, yet within infrastructure, each sector has its unique parameters and criteria for evaluation. The sector, as I said, being covered today is the transportation vertical, which includes roads, airports, ports, and metro in funding. All these sectors have globally gained prominence due to huge public-private participation that is there in these sectors. Now I move on to introducing the speaker for the day. Maulish is a senior director, is a director and rating head with CARE Ratings. He has a bachelor's degree in engineering and has done his MBA finance and is also a cost and works accountant. He is also a certified associate of the Indian Institute of Bankers. He has more than 17 years of industry experience, including 14 and a half years with CARE Ratings, and is a specialist for transportation sector and handling portfolio of infrastructure sector companies. Prior to joining CARE, he worked in credit appraisal department of a private. I will now hand over the proceedings to Maulish. Hope you find the discussions useful. I would urge you to let him complete the presentation before we move on to Q&A. So over to you, Maulish.
Good afternoon, everyone, and warm welcome to all the participants. So I will share the screen. Is this visible?
Yes, it is, Maulish.
Yeah, thank you. So in today's session, we will look at the infrastructure project evaluation with a transportation sector focus. So hope this will be useful to all of you. At the end, we will have a Q&A session. So I can also have an insight from all of you. So let's begin the session. If we look at the agenda of today's session, so we will look at the various risk evaluation parameters for the roads, ports, and airport sector, along with their case studies. So let's begin with the risk evaluation for the transportation projects. So risks are categorized into the sponsor risk, financial risk, regulatory and or political risk, project risk, revenue risk, and O&M risk. Among all those three, attributes pertaining to sponsor risk, financial risk, and regulatory risk are common within the subsector of the transportation, while attributes pertaining to project risk, revenue risk, and O&M risk vary depending on the subsector of the transportation, that is roads, ports, airports, and metro. So in the presentation, first we will discuss onto this sponsor financial and regulatory risk, which have a common attributes among the various subsector of the transportation. Then we will see that how this revenue, project, and O&M risk vary depending on the subsectors of the transportation, along with the case studies. We will also look at the sector trends of all the subsectors along with that. So now beginning with the sponsor evaluation. Credit profile of the sponsor has a paramount importance in the under construction projects. Sponsor plays a key role in the under construction projects for funding of the equity commitment, for funding of any shortfall in the cost overrun, and also for project execution. In India, in most of the cases, sponsor also acts an EPC contractor, and therefore deterioration in the credit profile of the sponsor can result into the delay in the project implementation. Of the projects, hybrid annuity model projects awarded by National Highway Authority of India between 2016 to 2019, projects worth $1.75 billion were delayed and attributed to the weakened sponsor. Apart from the credit profile of the sponsor, we need to evaluate the past experience of the sponsor in executing the projects and the ownership. Although there are joint and several undertakings given in case of the joint ownership, but in case of the delay in the infusion of the one sponsor, that result into the delay in the project evaluation. Now we look at the financial risk evaluation, beginning with the bidding analysis. Aggressive bidding sabotages the project viability, and prudent bidding enhances the cash flow returns on the projects. So while evaluating the bidding, we need to look at the number of bids, difference between the L1 and the lowest bidder and the second lowest bidder and third lowest bidder. What are the differences? Then what is the difference between the authority cost and the lowest bidder cost defined as the L1? So just to give an example, from the Indian context, National Highway Authority of India has relaxed the bidding norms 2 years ago. So that resulted into the aggressive bidding in the HAM projects over last 2 years. So median bid which were low at a 4, median bidder which were low at a 4, that is increased to 8 in 21, and the maximum bidder reached to close to 20. Subsequently, there is a surge in the commodity prices. Hence, aggressive bidding along with the surge in prices are expected to moderate the return for the developers and can also result into the delay in the project execution. Second aspect is the all transportation projects have a cash flow based approach. Unlike manufacturing company, here there is a waterfall mechanism wherein there is a defined priorities of cash inflows and cash outflow with the stricter restricted payment covenants. Therefore, cash flows after meeting all liabilities and required reserves like debt service reserve account (DSRA) and major maintenance reserve account for creating the completing the major maintenance, and also some types of the cushion like to minimum DSCR requirement, only that surplus cash flow is available to the sponsor. So this results into the building up of liquidity at the SPV level, which can be utilized in the time of exigencies. For example, during the COVID time in India, investment grade rated toll road projects of CARE remained COVID resilient because of this type of liquidity buffer. Then we also look at the project leverage. In the manufacturing company, leverage is defined by the debt equity, while in the case of infra, we look at the debt by revenue, the revenue generating capability of the asset and the EBITDA generating capability of that asset. So we need to look at the debt by cash flow available for debt servicing, that is largely EBITDA, and debt by revenue vis-a-vis a balance concession period to check the debt service capability measured by the debt service coverage ratio. Financial flexibility is measured by the concession life coverage ratio. Being a long-term concession, of a 20 to 50 years in case of airports. So it derives a significant financial flexibility for refinancing, that is depending on the concession life coverage. This concession life coverage is calculated based on NPV of the cash flow available for debt servicing throughout the tenure of the concession divided by the outstanding debt. Higher the CLCR, better the financial flexibility. Moving to the political and regulatory risk. So we have seen that transportation projects are also susceptible to the political risk also. In just to give an example, in case of the one of the rail projects awarded by Zambia, that concession is of 20 years. However, the project terminated early by the government, citing the mismanagement by the developer, and that lead to the subsequent disputes. So that is the example of the political risk. Apart from that, there are regulatory risks. Availability, that first is availability of the permits and statutory clearances like forest clearances, then design approval for rail over bridges. Then second aspect is the concessioning authority, whether it is a regional or a national. In India, we have seen that the national authorities, the concessions, those are more consistent, while in case of regional authorities, they have allowed exemption of toll of cars in some of the states. So that increases the risk. The third is the enforcement of concession terms. So concession agreement has some of the terms which are in the favor of the developer and which are in the which are there to protect the lender's interest. However, on ground, there has been a tardy implementation of those terms of concession agreement, and at sometimes there has also been the reneging of the contractual terms. Just to give an example, for in a roads in India, delay in the descoping of the unavailable land. In the case of metro, the fixation of the lower tariff as compared to what stipulation in the concession agreement. And in the case of airports, delay in the tariff order. So this results into the regulatory risk. Now we will look at the O&M risk, revenue risk, and project risk for the subsector of the transportation, that is road, port, and airport. Let's start with the road sector, wherein we will cover the sector trend first. Then we will look at the project evaluation and case studies. If we compare the toll road concession in the various countries, in India, there is a fixed period of the concession, and the extension of concession agreement is allowed in case of underachievement of the target traffic. And this extension is restricted to the 20% of the concession period. While if we look at in the USA, there is a flexible term of a concession with a tenure is linked to the aggregate project revenue reaching the predefined NPV. So this protects the interest of the developer and also the lender. While in case of Europe also, there is a variable tenure of the concession with the terms of extension linked to the recovery of the capex and O&M cost. So developer can recover the cost incurred for O&M and MM in that. Why road projects fail? So we have learned that some of the road projects have failed because of the delay in the approval of land, delay in the approval as well as the issues in the land acquisition, weakening credit profile of the sponsor, change in scope, aggressive bidding, lower toll revenues, inferior riding quality, and cost overrun. Now we will look at the evaluation of the road projects. Beginning with the project risk. The first and foremost important parameter is the availability of the unencumbered land. Sometimes ROW is available, but it may not, it may be with the encumbrances. There could be possibility of the utilities or trees which require the permission from the authority. So therefore, availability of the unencumbered ROW is required for timely completion of the road projects. In India, now authority has allowed the 80% land in India. Before commencing the projects, 80% land is handed over by the authority. So that mitigates this ROW related risk. Then also we need to see the planned progress versus actual progress. And third is the terrain or structural work. The higher the structural work, higher the project risk. And the most important parameter is the timely issuance of the extension of time. Sometimes there has been a delay in the issuance of the extension of time by the authority for the delays attributed to the reasons of authority. because of the delay in the issuance of the extension of time, there could be possibility of repayment, commencement of the repayment of the loan prior to the COD. Now we will look at the revenue risk. In case of annuity projects, we need to see the track record of annuity receipt and the counterparty credit profile. The revenue risk of toll road projects, we will see into the next slide, wherein CARE Ratings has undertaken a study on a 46 operational toll road projects and then formed a revenue metrics for the toll road projects for the project attributes. So we will, in this slide, we will look at the project attributes and how the risk is vary. So first project attributes is the track record of toll collection, which is the most important parameter. The longer the operational history, the project becomes mature and the toll revenue risk reduces. In contrast, no projects with a no operational history and reliance on only the traffic study, the revenue risk increases significantly, while the revenue risk remain moderate for the projects, brownfield projects, which are expanding from 4-lane to 6-lane. If there is a fixed hike in the toll rate, then the revenue risk is considered to be a lower as compared to the inflation-linked toll rate hike. Traffic behavior. If there is a higher captive traffic on the project stretch, then it is independent of any diversion, positive diversion from the other stretches, and it is perceived as a lower risk. While if any particular stretch which rely on the positive diversion from other connecting road, or they are relying on the developmental traffic, suppose if any industry is expected on the stretch, so they are expecting some 20-25% growth post commissioning of that industry, so that results into the significant traffic risk. In case of the delay in the implementation of that project, that can impact the revenue of the project stretch. Then the location of the stretch, standalone facility, suppose for example a bridge crossing the river, so that is a standalone facility perceived as a lower risk. Threat from alternate route is a biggest risk in the toll road sector. Then traffic mix, the diversity globally, passenger traffic contribution is higher, then the revenue risk is perceived as a lower. Traffic growth rate is very important parameter, and based on study we have inferred that the realistic traffic growth rate should be 4% over a CAGR basis till the end of the concession, which can mitigate the traffic risk to an extent. And the final point is the overloading estimates. So some of the stretches might have a higher reliance on overloading, and therefore in case of a change in Excel norms which happened already in India, the revenue of those projects can be impacted. Now we will look at the O&M risk. So as seen from the chart, cracking, rutting and potholes. These are the three major O&M defects. This can result into the higher O&M expense and sustains continuous higher O&M requirement. Further, this type of defect can also result into the toll suspension in toll projects and annuity deductions in case of annuity projects. So if we want to evaluate the O&M risk, if we see at the on the left side of this slide, we need to see what is the actual traffic in million standard Excel vis-a-vis the design traffic. If the actual traffic is lower, then the O&M requirement would be lower. Then second is the terrain design. So if the project is located in the hilly region with a high rainfall, then the O&M requirement would be high. Third is a pavement design. So in case of a flexible pavement, O&M requirement would be higher because of the requirement of the replacement of the bituminous layer. While in case of a rigid pavement, that O&M requirement reduces considerably. Third is the benchmarking of O&M and MM cost with the comparable road projects to check the adequacy of the O&M and MM cost. Fourth parameter is a roughness index. Roughness index is measured in the mm per kilometer. Lower the roughness index, better the riding quality. So that is, therefore it is very important parameter. And last is the creation of adequate major maintenance reserve. So creation of adequate major maintenance reserves help the toll projects in case of any exigencies. So now in this slide, we have also shown various methods adopted by the developers to conduct the O&M. That includes the test pits also, where the analysis being done for the bottommost layer of the road, that is granular subbase, to check the defects. And also this network vehicle survey is used to measure the roughness index. After completing the risk evaluation on the roads, we will look at the case studies. So we have masked the names. These are the actual case studies. So we have masked the name. So we will start the first case study, that is a Hillways tunnel. This tunnel is spanning for 9 kilometers at a 10,000 feet altitude in a hilly terrain. This hilly terrain, if we look at the cost overrun, so there has been a 640% increase in the cost, and also there was a delay in completion of project by close to 11 years. The key challenges are the geographically mountainous terrain with the 46 avalanche sites. That is first challenge. Second is the north portal was completely inaccessible in a winter. That results into the partial halt of the construction. And third is the extremely difficult excavation of the rock. If we see the excavation quantity of this site, it was very high at 8 lakh meter cube. So that has increased the challenges. So since it is in the hilly area with a soft rock, so that has increased the challenges. Now, if we compare any other tunnel project, which is not, which is in the hilly area, but it is with the hard rock, so in that case, the execution challenges reduces. Second case study is on the for the annuity project for the O&M cum sponsor risk, wherein the 17-year concession agreement is signed for the 4-laning of annuity projects. If we look at the case facts, so there was a weakening in the credit profile of the sponsor, which has accentuated O&M risk, and because of the underperformance in the O&M contracts, and there was a annuity deductions by the authority, which resulted into the weakening of the debt coverage indicators. However, there are risk mitigation measures in the loan covenant, which has helped this SPV to sustain despite weakening of the O&M contractor. So first mitigation measure is since there is a cash trap mechanism, so significant amount of cash is built up in the SPV, which has been used for meeting the O&M and MM requirement. Second, there was a creation of DESRA and MRA, and because of this adequacy of the major maintenance cost, the lender can substitute the weak O&M contractor with a strong O&M contractor. So these are the prominent risk mitigation measures used by the lender, which has helped this project in survival. The third example is on the revenue risk of the toll road. So one toll road project in India with a length of 80 kilometers. If we look at the case fact, actual toll collection was lower by 40 to 45% as compared to the traffic estimate. Second, there was a aggressive bidding in the premium with a higher difference between L1 and L2. So premium outgo was very high. So underperformance in the toll and the higher premium requirement resulted into the premium outgo close to 50% of the first year of the toll revenue. So this resulted into the complete exhaustion of the DESRA and sustained underperformance of the SPV. If we look at the key reasons for the underperformance, the first more is the there were higher toll leakages in the bypasses. Further, there was a diversion of traffic to alternate route created by the state highway. Moreover, while conducting the study, there was an underestimation of the exempted vehicle, and while achieving the COD, the local vehicles were higher. So those were exempted from the toll. This and hence larger than envisaged exempted traffic has also resulted into the lower tollable traffic and impacted the low toll collection. And the last is that the higher difference between L1 and L2 bid. So this is the case study of the revenue risk. Now we will look at one case study of a metro project wherein the regulatory risk has impacted the project. So there is a cost overrun of 184%. This cost overrun, we have seen that largely the cost overruns are higher in the railway segment because of the design related challenges and the ROW related challenges. Also, there is a delay in the completion by the 2 years. So key reasons for the failure of this project is the no leasing of additional retail space. So that results into the lower non-ticket revenue and metro project need to rely only on the ticket revenue. Further, in ticket revenue also, there is a delay in the fare fixation by the authority. So that is the example of the regulatory risk, and because of that, this project suffered. Now we will move to the port sector, wherein also we will cover the industry trend, project evaluation, and a case study. Median maritime trade to GDP ratio globally is 1.13 times for the calendar year from 2010 to 2021. Hence, this cargo has a close linkages with the GDP. Technological advancement has helped reducing physical contact during the COVID time, and this resulted into the uninterrupted movement of cargo across the border, and therefore port projects were COVID resilient during 2021-22. Asia contributes a lion's share of global cargo, marked by 67% of global cargo in import and 41% share in export volume. Globally, earlier also there was a higher degree of containerization. However, in the developing country like India, the containerization share was lower. However, for the period, if you look at 2013 to 2021, container volumes grew at a CAGR of 9.5% in India, as against the global CAGR of 3.13% during this same period. If even during FY21 and FY22, there were acute shortage of containers due to challenges related to the COVID-19 pandemic, Ukraine-Russia war, and threat of hyperinflation. Container freights has also risen significantly. Despite that, if we see the chart from the left side, the share of container in total cargo mix in India has increased from 18% to 21.16% in FY22, corroborating the trend of containerization. If we look at the cargo mix in India, so generally the port cargo is classified by the 3C, that is coal, container, and crude. These are the three major commodities across the world. And within that also, if we look at the coal, so we expect that the coal volume is expected to grow at a nominal rate of 2% CAGR over the years because of the ESG related concerns and increase in share of the renewables. The another important parameter for the port sector is a railway connectivity. If we look at this slide, in countries like USA, share of railways in overall freight traffic is 50%. In countries like Germany, China, and Japan also it is high as 40%. While in India, share of railways in overall freight traffic is only 21%. This is due to lower speed of train and higher freight rates. However, over last 2 years, there has been a significant focus of Government of India on dedicated freight corridor, container freight terminal, and high-speed double-stacker container train. This is expected to improve the rail coefficient of India and in turn increase the transshipment cargo volume, which is positive for the sector. Now we will look at the some of the reasons that why some of the port projects failed. If we look going into the detail, the first reason is the higher proportion of minimum guaranteed tonnage. So just to give an example, if any port terminal has a installed capacity of 15 million metric ton and the minimum guaranteed tonnage is for the first year is at a 5 million metric ton. So the 33% of the capacity is already guaranteed by the developer. So in case of the lower cargo, they need to pay at a 5 million metric ton. So this exposes the terminal to the significant market risk, especially in the initial year where the ramp up could be the slower. So higher proportion of MGT exposes the port company to the market risk. Second is the absence of a deep draft. Some of the ports have a shallow drafts of 7 to 10 meters. So they could not handle the large size vessel. While some of the ports have a deep draft of 14 to 17 meters, they can handle the large size vessel. So shallow draft ports can handle the Handymax vessel with a 48,000 deadweight tonnage volume, while the deep draft ports can handle the capesize vessel with a volume of 4 lakh ton deadweight tonnage. The another parameters are competition from nearby ports and limited hinterland prospects. Those are self-explanatory. Fifth parameter is inadequate evacuation infrastructure. Sometimes there is an absence of last mile rail connectivity. So that increases the challenges related to the cargo evacuation. This challenge is accentuated in the cases where there are limited hinterland prospects. So in those cases where there are limited hinterland prospects and there is a limited connectivity, especially rail connectivity, then the port has a limited ability to attract the long distance cargo. And the last is a cargo concentration. Some of the ports may be concentrated in cargo in terms of a coal and iron ore. So this exposes them to the fluctuations in the cargo volume in case of the volatility in these prices of this commodity and any regulations imposed by the government. Now we will quickly look at the evaluation of the port projects. So statutory clearances is the paramount important for the port projects, whereas the approval for land, coastal regulation zone, those two are very critical. And the third one is the evaluation of a detailed project report for the greenfield projects. Many times it is observed that the actual dredging volume would be substantially higher than what is originally estimated. That results into significant cost overrun. Moreover, there are also delays in the breakwater construction because of the inadequate detailed report. So therefore, evaluation of a detailed report is very important. And the second aspect is the quality and track record of the EPC contractor and the timely delivery of the equipments. The third point is the regulatory risk, where the tariff risk. Some of the, in India, like the major port trust govern the tariff of the ports. So that is one regulatory risk. If we look at the revenue risk in the operational ports, so that is classified by the 3C, that is capacity to handle the large size vessel, cargo mix, and the customer concentration. So all those three we have already discussed in detail earlier. Apart from that, the most important parameter is the turnaround time. So the lower the turnaround time, better the efficiency. Over the years, the Indian ports have shown significant improvement in the turnaround time. So in case of the container ports in India, now the turnaround time is comparable with the global players. But for the bulk commodity, the turnaround time in India is close to 63 hours as compared to 49 to 56 hours for the country like China, Australia, and France, and some other countries. Operational risk. So two major risks we have already discussed. One is the evacuation risk, and the second is the dredging related challenges. In the dredging related challenges, the major risk is sometimes there are two separate concessions for the dredging and for operating the port. So that is a major risk. So in case of the failure of the contractor who is conducting the dredging, that can result into the lower cargo at the port. So that is one risk then we need to see. Now we will look at the case studies of the operational operational transshipment terminal of India that is operational since FY11 2011. It is built with the project cost of USD 40 million. Container handling capacity is 5.5 million TEU per annum. However, if you look at the actual container volume, so it is very low at 0.6 million TEU per annum. That resulted into the significant operational losses. If we look at the key reasons for the same, the first is the voluminous dredging work. Here also, it is since the draft is shallow, it required a significant quantum of the dredging, and also because of the higher siltation also, the dredging requirement was very high. That resulted into the very high cost. And second is the pricing flexibility is also limited to this port, and because of the higher dredging cost and higher maintenance cost, the nearby transshipment terminals, they were more competitive, and there were competition is higher from the nearby transshipment terminal, and the major ships, those have basically diverted to the nearby transshipment terminal. So these are the challenges. Another example of the revenue risk is the Evergreen port, which is a all-weather port and constructed with a state-of-art cargo handling facility with a capacity to handle a 40 million ton per annum. project is also completed timely, but it could handle only 12 to 15 million tons per annum, which has moderated the project IRR. If we look at the key challenges in that, the first is the limited hinterland prospect, and that is accentuated with the cargo evacuation challenges with a absence of last mile rail connectivity. So because of that, berth occupancy rate were consistently lower. Further, there was a concentration in the cargo mix, and cargo is concentrated to coal and iron ore. So these are the prominent challenges. Now we will move to the airport sector. If we see from the chart left side, the share of privatization of airport was high in Europe at 43%, followed by the Asia Pacific and Latin America, while the share of privatization is lower in case of Africa, North America, Middle East, and even India at 5%. However, traffic handled by private port in India is high at a 53%. Before we discuss this regulatory framework in the airport in this slide, let us understand what are the airport charges. What are the charges airport recover? So those are the aero revenue and the non-aero revenue. Aero revenues are the landing charges, parking charges, and cargo handling charges recovered from airlines by the airport, while the non-aero revenue charges are the duty-free, food and beverages, parking, and retail charges recovered from the passengers. So these are the two major revenue globally, the aero revenue and the non-aero revenue. Based on this, three types of the concessions are prevalent globally: single till, dual till, and hybrid till. In case of single till, there is a 100% cross subsidization of non-aero revenue with the aero revenue. This is to attract the airlines. So in case of the smaller cities, where there are difficulties in attracting the airlines and non-aero revenue is less, single till model is prevalent, while generally dual till and hybrid till model is preferred, wherein in dual till there is no cross subsidization of aero revenue and non-aero revenue. Therefore, higher charges for airlines and more revenue for the airport operator, and maximum this is the dual till model. While in case of hybrid till, non-aero revenue is cross-subsidized to the extent of 30% with the aero revenue. So that is also the good model. And in India, hybrid till model is adopted. If we look at the till types at airport, so globally, dual till is adopted with a 52% of the total airports. Now, what are the reasons for the failure of the airport projects? Aggressive bidding and higher revenue sharing, competition from the nearby airport, delay in the approval of the capex by the authority, delay in the issuance of the tariff order, and inadequate monetization of the non-aero revenue are the prominent reason for the failure of the airport projects. In case of airport projects, project risk is considered to be a relatively moderate. O&M risk is considered to be relatively lower. The major risk is the revenue risk. So in case of to analyze the revenue risk, we need to see the mix of aero and non-aero revenue. If the aero and non-aero revenue is the mix is proper, so then the risk overall revenue risk is mitigated. And to analyze the revenue risk, we need to see the market position and the passenger base. So where the passenger base is larger, privatization of airport is preferred, while the passenger base is smaller, then it is generally owned by the government. Then also we need to see the catchment area of the airport and the competition, whether any competing airport is there in the radius of the 200 kilometer of this airport, 200, 300 kilometer, that also we need to see. Now, if we see the Indian scenario of the airports, so aero revenue constituted 53% of the total revenue for all domestic private airports for FY17 to FY20. So this takes care of any fluctuation in the traffic during the next control period. Globally, also we have seen that the aero revenue constituted 54% of the total revenue in the past. However, on a flip side, in India, there is a relatively low penetration of non-aero revenue. Non-aero revenue, if we look at the yield per passenger for non-aero revenue, it is though increased, but it is low at a USD 2.65 per passenger in FY20 as compared to the world average of USD 5.3 to USD 15.38 per passenger. Now we will look at the one case study on an operational international airport of Spain. This airport is built with an objective to be an alternative to main airport of Spain, that is Madrid Airport. It is operational since 2009 with a capacity to handle 2 million passenger per annum. However, if we look at the case fact, so passenger traffic continued to remain subdued for a longer period of time. Airport could not attract the airlines. Construction cost of the project was very high, 1.1 billion. And because of the lower traffic during COVID-19, this airport was used to park the aircraft instead of the passenger movement. And ultimately it sold for euro 10,000 only to the new company. If we look at the key reason for the failure, the first reason is the lack of connectivity of airport with the high-speed railway. So the passenger need to travel 3 to 4 hours to reach this airport. So that was one bottleneck. Secondly, simultaneously capacity expansion was also there in Madrid airport, owned by the different sponsor. That resulted into the traffic diversion to the Madrid airport. Third is the financial crisis in the Spain during the initial year of the operation. And the fourth, since the cost is very high at euro 1.1 billion, aero charges are very high. And because of the aero charges are high, it could not attract the airline. So these are the reason for the failure of this airport. So with this, we have completed the risk evaluation of the various subsector of the transportation. And now we will look at the risk evaluation meter for the transportation sector. So beginning with the project risk, from this slide, we can infer that the project risk is high in case of the roads project and metro projects, while in case of the airport, this project execution risk is relatively moderate. The revenue risk is relatively low in case of the annuity road projects, while it is higher in case of the toll road and metro projects. O&M risk, if we see, it is on a higher side for the road projects, both toll and annuity. However, it is lower for the metro and airport projects. The port, it is on a moderate side. And the regulatory risk, it is higher in case of the airports and the metro, while on the other side, even in the toll road projects, the regulatory risk is higher, while for annuity and ports, it is low to moderate. With this, we end the presentation. Thank you. Thank you very much. Now we shall open the forum for the Q&A. So any participants want to ask?
So any participant who wants to ask a question can unmute and start your video and ask the question. Anybody who requires any more elaboration on any of the transportation verticals can also ask their questions. Let me ask a question, to begin the session. Molish, you said that, in an airport, you have moderate revenue risk, you have moderate project risk. From all these projects, seems like airport is a relatively safer bet to kind of get into. But isn't there a huge capital outlay in an airport project as compared to any other projects that we might look at? And how do you view that in terms of how would you then evaluate the sponsor strength to take up those kind of projects of such a large magnitude?
Yes. So airport projects, if we look at the concession also, so those are for the longer concession of a 50 years, vis-a-vis a road concession of 15 years only. So the longer concession provides the more revenue visibility and a financial flexibility to the developer. And because of the longer concession, those can sustain a high capital cost and the high debt level also. But yes, the sponsor related challenges we need to see, and that is common across all the subsector of the transportation. So if the credit profile of the sponsor is a moderate to weak, so those projects can face the issue. And Navi Mumbai Airport of India is one example of that, which faced the challenges in execution mainly because of the sponsor related issues.
Okay, thank you. Yes, Mr. Billah, would you want to ask a question?
Yes, my name is Mir Arif Billah. I am from Bangladesh. I work in Credit Rating Agency of Bangladesh Limited. I have a question regarding expressway and metro rail. In Bangladesh, I observed the expressway are operated BOOT, build, own, operate, and transfer. Uh, but the metro rail project, I don't have any idea. Ideally, which model do you prefer, or in India, which model are practiced in India for the metro rail project? Does it is under the PPP project? Is the metro rail project? Can it run the metro rail project under the private public partnership project? This is my question.
Yes, so in India also, some projects are there on a PPP mode in India also, like one project in a Pune, which is on a PPP mode. A project in a Bangalore is also in the PPP mode in India on a BOT basis.
My question is that if metro rail operates under the uh, BOOT, then who own the metro rail? There is a difference between expressway or road and the metro rail. In case of road, they only operate the other transportation, public transportation, private transportation, run over through the road. But in case of metro rail, who own the train? Who maintains the train? That is my question actually.
Yeah, so maintenance activity also needs to be done by the that developer only. And after the end of the concession, it is asset is to be handed over to the authority.
So initially, this is a property of the concessionaire. He own it and he operate it, and after certain period, this asset transferred to the government authority. Is
Yes,
it?
yes, yes, yes.
In India, is there any such way the metro rail project BOOT or any other module in case of India? Which model?
Yeah, in India also BOT is prevalent. So
And is it financially viable? Is it operating in a as a successful project in India?
so for that we need to see the as we discussed in the case study, we need to see the tariff fixation thing, and how much of the non-ticket revenue that metro can generate. So these two are important thing, and in sometimes because this is a metro project is of the interest of the larger public, so then they cannot sometimes they may not hike the tariff regularly, so that can impact the returns of the project. That is one aspect. And the second is that the project should also able to generate the non-ticket revenue through advertisement, through retailing of the additional space. So if there is a delay in if the revenue is lower than estimated from the advertisement and the retailing, so that can impact the project revenue in India and globally also.
Okay, thank you. If I have any more question, I will ask later.
Thank you. So I assume that there are no other questions by the participants. Yes, Des Tabarina, please go ahead.
Good afternoon. I just would like to ask the speaker if there has been any, what has been the general trend in the ratings of the airports, considering that it has been a very difficult time for the aviation and tourism industry because of the COVID-19 pandemic.
Mhm. Yeah, so if you look at the globally also, like the Heathrow Airport, which is the world's sixth largest airport. So the rating of the Heathrow Airport was downgraded, and then outlook also revised to the negative. One of the airport in Indonesia also, the rating was downgraded and the outlook revised to negative. And India also, the one airport's rating was downgraded. Others airport that those where they could withstand those COVID related challenges. Only outlooks have revised negative by the CRS. So that is in India, and globally, like in USA and Canada also, the rating has been revised by a notch, and then outlook kept to negative because of the COVID related thing.
Then I take it that we don't have any other questions. So thank you to all the participants for attending this workshop. We hope that you have gained from our experience and expertise. To sum up, some of the things that we touched upon as part of this presentation is that there are varying risk intensities within various subsectors of the transportation sector, namely roads, metro, ports, and airports. So the risk evaluation methods and identification and mitigation of risk would also vary across these different sectors. Sponsor risk carries a very high importance in under construction projects, while evaluating revenue risk is very critical for operational projects. Metro projects have faced major cost overrun followed by road projects. Understanding revenue risk is extremely critical in toll road projects. Understanding the prospects of the hinterland, adequacy of draft, evacuation infrastructure, and cargo diversification are crucial for ports. While returns from airports are dependent on timely issuance of tariff orders for aero revenue and developers' ability to monetize the non-aero revenue. Enforcement of concession terms on ground and credit profile of the counterparty or the project awarding authority remain equally important. So in a nutshell, project execution capability of the sponsor, bidding prudence, market dynamics, project leverage, implementation of regulatory framework, all these factors drive the risk evaluation framework for the transportation sector. Thank you so much, Maulish, for an insightful presentation and the audience for their participation. Thank you, ACRAA, for giving us an opportunity to make this presentation. Special thanks to Mr. Santi. I look forward to more such meaningful discussions. In case you need any clarifications on this, you can reach out to ACRAA. So I conclude this webinar for today. Thank you so much.